Hey, good day, everyone. Welcome to another Gables Tax Planning Group webcast. My name is Bert Salazar, and I'm going to be your host. I'm just going to take a few minutes of your time because this is Memorial Day weekend, so I'm hoping that all of you are going to have a great time. I'm actually in my little home in the Keys, and just relaxing. I do have a webinar that I'm going to be doing from the Keys tomorrow, so. I'm excited. We just had a seminar last week that I conducted on Saturday at Florida International University up in Miramar. And this is a workshop that we do once a month relating to, the challenges of retiring in the 21st century. So, a lot of questions come to mind. So I just wanted to take a few minutes and bring something to you that I think is going to be very, very important. Now, we just went through the 2018 tax year. So we just finished all the taxes. We do still have, some business taxes that we need to finalize. But, we did a really good job in getting the vast majority of our clients to be able to file their taxes on time. So what I want to talk to you about today, this episode is called, Are You Wasting Away Your Standard Deduction? And that's a very important question for most of you that are getting ready or preparing for retirement, because one of the things that we are seeing under the new tax law that, for those of you that may not know this, President Trump signed into law back in December of 2017, the Tax Cuts and Jobs Act. And what the law did, now there was a lot of things that this law did, not only from a personal standpoint, but also from a business standpoint. But some of the critical things that the law did was it actually reduced the tax brackets and increased the standard deduction. So therefore, for those of you that file your taxes in 2018, the vast majority of the clients that I engaged in tax planning and tax preparation for 2018 actually saw a reduction in their taxes, not only at the time of filing, but then obviously throughout the year as they were getting their paychecks, if they were W-2 employees, because the brackets were lower, so the withholding was less, so you actually received a higher paycheck. So I kind of wrote a few notes that I want to talk to you about very briefly, so I can let you go and you can enjoy the rest of the weekend, just like I want to do. But one of the things that we're not noticing, and that I did notice for 2018, and this is something that the IRS, had already talked about, was that because of the new tax law and because of the greater standard deduction, the vast majority of Americans were going to be taking the standard deduction as opposed to itemizing their deduction. Now, what's important to note about this is you need to make certain that you understand the difference between the standard deduction and the itemized deduction. If you were a single filer in 2018, your standard deduction went up to $12,000. If you were married filing jointly, your standard deduction went up to $24,000. But what if you are in retirement, or what if you're getting closer to retirement, and all of a sudden you notice that when you itemize your deduction, you only have like $15,000 in itemized deduction. So there's an arbitrage between the itemized deduction of $15,000 that you could have claimed and the $24,000 standard deduction that the government has given you. So obviously, you're going to be taking up the standard deduction. The challenge is that there's $9,000 arbitrage, or the difference between the $24,000 and the $15,000, that you are wasting away from a tax planning perspective. So what if you have some IRAs money? Would it make sense for you to start doing Roth conversions? So you can actually do a conversion from a traditional IRA where everything would be taxable to a Roth IRA, in which once you put the money into the Roth, the money will grow tax-free for the rest of your life, and it would not have a negative impact on the taxation of your Social Security benefits and or your Medicare premium. Now, in order for you to be able to do that calculation, you need to, work with a tax planner, because most accountants do not have the ability to do those calculations because they don't have the tax planning software to be able to do that. So what we try to do at Gables Tax Planning Group is to make certain that not only do we do the tax preparation for the tax year for our clients, but we also do tax forward planning, which gives us the ability to formulate these calculations in order to be able to convert as much money as we possibly can from your traditional IRA to a Roth IRA without having to pay any federal income taxes, because now you're leveraging the arbitrage of your standard deduction, thus giving you the ability to put money into a qualified plan on a pre-tax basis, have that money grow tax deferred, and then when you thought you were going to have to pay taxes on the whole thing, we're able to leverage and do the tax leverage and then be able to convert to a Roth without you having to pay taxes. So now you have the best of all worlds. So that's very important to note. The challenge for the vast majority of Americans is they don't do those calculations. So they're wasting away their standard deduction because you don't get it back. You know, once you go through the tax year, if you don't maximize the standard deduction, then you might as well kiss it goodbye and wait till the next year. And then more than likely next year, you're going to waste it away the same way. So I think it's time that you really start paying attention. Now, obviously, for those of you that may have additional questions for me, please feel free to reach out. You can call me at 786-766-1042. No cost, no obligations to you. You can also email me at Bert, B-E-R-T, at gablestaxgroup.com. And again, we can schedule a 30-minute call at no cost or obligation. And at least I'll be able to give you some ammunition that you can take with you in order to maximize or minimize your tax liability as you prepare for retirement. A couple of other items that I thought would be very important was the fact that for 2019, and this is very important for all of you to know, the standard deduction again has gone up for the 2019 tax year. So in 2018, if you were single, it was $12,000. Well, for 2019 will be $12,200. If you were married filing jointly in 2018, you had a $24,000 standard deduction. Now for 2019, it has gone up to $24,400. So again, you need to keep an eye on that. You need to keep an eye on your itemized deduction. And if you do tax forward planning, then you'll be able to identify how much money can you transfer from an IRA to a Roth IRA using tax leverage and avoid having to pay any type of federal income taxes. If you're married filing separate, is $12,200 in 2019. And then obviously, if you're a head of household, it is now $18,350 for the 2019 tax year. Again, obviously, make sure that you understand the taxable buckets and that you also understand, you know, where you're situated from an itemized deduction. Again, because of the new tax bracket, there's a very high probability that only between 20-25% at most of Americans are going to have to itemize. Everyone else is going to take the standard deduction because it is going to be higher than anything you could have itemized, because as you get closer to retirement or you actually retire, you're going to lose a lot of those itemized deductions that you had prior to that. One critical aspect, and the reason why I wanted to do this short webcast, is that you need to have a very clear understanding of your taxable bucket, your tax-deferred bucket, and your tax-free bucket. Again, most of the planning that I do for new clients, what I do have a tendency to find is that the vast majority of these clients have all of their money, all of their retirement assets, either in the taxable bucket or the tax-deferred bucket. Now, the taxable bucket is, you know, primarily your CDs, your money market accounts, your traditional mutual funds, and so forth. And the reason why you know that it is a taxable bucket is that every single year, the institution that you have your money invested with, depending on the growth of that money, will actually send you a 1099 for you to report to the IRS with your tax return for that given year. Now, the tax deferred bucket, so in the taxable bucket, the money goes in after tax. every year you're going to get a 1099 on the growth of that money. And then when you sell your shares, if you happen to be in a mutual fund, you may have to pay additional taxes at that point in time. So from a taxable standpoint, the taxable bucket is the worst bucket to own, but it is a very important bucket from an emergency standpoint. So we do recommend our clients to keep, a maximum of 6 months of expenses in the taxable bucket. I don't care, what the rate of return is on that bucket, because that bucket is there to make certain that if you have an emergency, that you have readily accessible funds that you can dip into right away. Obviously, not more than 6 months. Now, sometimes you may say, Bert, I'm in the process of looking for a piece of property that I want to pick up, so I want to keep maybe a year's worth, but I'm only going to do that for the short term. And my answer would be, okay, you can do that. Now, the tax deferred bucket, this one most of you know. This is where you have your IRAs, your 401ks, your pensions, your deferred compensation program if you work in the public sector or the private sector. So this is where you have to be very careful, because yes, the money that you put in is pre-tax. The money grows tax deferred, but then when you pull the money out, the money comes out tax-free. The challenge with a tax deferred bucket is the fact that there's an optimum amount that you need to keep there. And the optimum amount is equal to your standard deduction distributions when you take money out of that bucket, and you want to make certain that you don't exceed that threshold. Because if you get to age 70 and a half, where now you have to have your required minimum distributions, if you have way too much money in the tax deferred bucket, you're not going to have any choice but to start taking a required minimum distribution, which that distribution would now be greater than your standard deduction offset or your tax leverage offset that you would have had under your traditional standard deductions, especially under the new tax law. And therefore, the additional funds that go above that threshold, in addition to all the money that you and the 1099s, so you're going to be receiving from your tax bucket, and also 50% of your Social Security benefits and interest that you may have received from municipal funds and or the sale of a stock or a piece of property or whatever that may be, that may cost very well up to 85% of taxation of your Social Security benefits, and that would be a no-no, because for the vast majority of people that don't do proper tax planning, if you have to pay taxes on your Social Security benefits, either at the 50% level or the 85% level, there's a high probability that you will run out of money 5 to 8 years sooner than expected. So you may get to a point in your life where you're running out of money before you run out of life. So understanding how the taxable bucket and the tax deferred bucket works is very, very important if you want to have longevity planning set aside, if you want to maximize your income without jeopardizing your tax deductions and your tax liability in retirement. Also remember that the tax deferred bucket, yes, you're deferring the taxes to today, but you're also deferring the tax liability. And what I can tell you is that for the first time in history, we now know when taxes are going to be higher in the future. And obviously the new tax law, the Tax Cuts and Jobs Act that President Trump signed into law, I think it was December 17th of 2017, will be sunsetting December 31st, 2025. So when all of us wake up January 1 of 2026, guess what? The tax brackets are going to be higher, our standard deductions are going to be lower, and therefore our tax liability will be greater. And because of all the challenges that we're having in this country, there's a very high probability that over the next 7 to 10 years, taxes are going to have to double, or our country is going to go bankrupt. The good thing is that if you put the vast majority of your assets in the next bucket out of the three, not the taxable bucket or the tax deferred bucket, but the tax-free bucket, then obviously that bucket is going to give you that shelter. Is going to give you that protection against any type of tax increases in the future, because if you happen to be in the tax-free bucket and taxes were to double in the future, well then 2 times 0, still 0. Now, what are some of the vehicles that go into the tax-free bucket? Well, you have your Roth 401ks. If you happen to be a lucky employee that has the ability to make a contribution to the Roth 401k, you may want to take that opportunity to do so, especially over the next 7 years. You also have a Roth IRA. You also have your 7702 plans, which are your cash value life insurance plans that enjoy some of the biggest benefits that anyone can enjoy under the IRS code. And then you would have municipal bond funds, or the income from municipal bonds. The challenge with municipal bonds is that they're not totally tax exempt, because the income that you may receive out of those municipal bonds are going to have to be included in the provisional income calculations, along with all the distributions from your taxable bucket and the tax deferred bucket, in order to determine what percentage of your Social Security benefits are going to be taxed in retirement. And even worse than that, it may actually increase your monthly premium on the Medicare premium that you need to pay once you reach the age of 65. So there's an optimum amount of money that you need to have in your taxable bucket and tax deferred bucket. Once you get to those levels, everything else should go into the tax-free bucket. So again, it's something that you need to keep an eye on, and you need to be able to manage both. You need to find the opportunities in which to be able to maximize all of your tax benefits, because if you're able to manage your tax liability in retirement, both you and your family are going to have a tremendous retirement life if you do it the right way. And you're going to be able to leverage all of those potential tax increases. And most important, you're going to be able to do away with them and have a beautiful tax-free retirement life, which is something that I specialize in working with my clients on an ongoing basis. Again, if you have any questions regarding this short webcast, my number is 786-766-1042. Again, 786-766-1042. You can also email me at Bert, B-E-R-T, at GablesTaxGroup.com. And I want to leave you with a final thought, which I do every single time that either I conduct a seminar or I conduct a webinar like I'm doing today, or a webcast as I'm doing right now, or one of my podcasts. For those of you that are podcasters and enjoy listening to podcasts, I encourage all of you to go into your app on your cell phone and pull up the Your Tax-Free Life podcast, which is my podcast. We have done already 75 episodes, so you have plenty of information that you can take with you. But I want to leave you with a final thought. The goal that I have for all of you that are listening to me and that are part of our world, our financial world, is that my goal is to help all of you change the way that you see things, because when you change the way that you see things, the things that you see change. So again, I am hoping that all of you are going to have an exciting and, most important, very safe Memorial Day weekend. And we'll talk again next week. Again, have fun. Just wanted to take a few minutes of your time, and don't keep me a secret. So if you know of anyone that may be interested in learning more about the techniques that we're using, feel free to make a recommendation. And that's something that is very, very precious to me from a business perspective. Take care and have a wonderful weekend. Bye-bye.